Hi guys, thanks for tuning in. Alright, the purpose of today's quick video is just to update you on what's been happening in the banking world over the last few weeks, specifically regarding interest-only loans and interest-only versus P&I repayment options that you have as a mortgage borrower. In response to APRA's regulatory intervention that we've covered extensively on the blog already, what we've noticed over the last few weeks is there's been a further hiking of interest rates out of cycle, particularly targeting interest-only loans. That's point number one. We're talking increases of maybe 40, 50 or 60 basis points. So the takeaway there is if you haven't checked your interest rate over the last 4, 5, 6 weeks, definitely check it now, because there's every chance that it may have actually increased without perhaps you even knowing. Point number two is a lot of the banks in exchange for that are offering really, really cheap and attractive principal and interest repayment options to try and win that type of business at the moment. So in terms of the interest rate differential between interest only versus P&I, it's a lot wider than it's been over, certainly over the last few years. The differences could be up to 60, 70, 80, 90, even 100 basis points different. And the kind of P&I rates that I'm talking about are about 3.88%, potentially even a little bit cheaper, depending on whether it's investment or owner-occupied and that kind of thing. So saving that type of interest on a loan is not insignificant. That's real cash, so not to be ignored. And lastly, I guess you've then got to ask yourself, well, how am I being disadvantaged, or what am I losing out on if you go with a P&I rate as opposed to an interest-only rate? Okay, don't think of it as a bad thing. P&I is good in the context of you reducing your debt, which is ultimately creating equity, and equity is net worth. That's increasing your wealth. So that is not that's a very good thing. It's essentially enforced savings. It's more discipline that you have, because whilst interest only cannot disadvantage you if you're just building up surplus cash in an offset account, as soon as you start spending that cash, if, for example, you're undisciplined, which unfortunately most people are, you all of a sudden end up paying more interest to the bank over time, which is what we want to avoid. Now, there are certain borrowers whom interest only does suit. Let's not ignore that. If you're in a house at the moment that's about to become an investment property, maybe you're moving into a new home and you're going to keep this existing home that you're living in as an investment, well, then there can be advantages of interest only. You want to perhaps keep that investment debt high and use some extra cash that you're building up to pay down the home loan debt on the new property. I understand that. And secondly, what if you've got an investment property but you've also got a home loan? The home loan being what we'd call bad debt, which you want to reduce. Well, then obviously having the extra surplus cash via interest only on the investment can allow you to work on repaying the home loan debt down more quickly. Or you might have other bad debts, call it car leases or personal loans or expensive credit card debt. All of that debt has a high interest rate and is not tax deductible. So it can be very beneficial to your circumstances if you can pay that down. And with the extra cash from interest only, say on an investment property, that can be an effective way of doing it. So let's not ignore that. Lastly, consider this: if you're on a principal and interest repayment, your repayments might be X, call it $1,300 a month, as opposed to interest only, where the repayments might be lower, call it $900 a month. What a lot of people don't realize is when that interest only period expires, well, now you've got to pay down all of the debt over a shorter period of time. So maybe you had 5 years interest only. At the end of the 5 years, you now need to pay down the debt over 25 years. So your monthly repayments are obviously going to be a lot higher from year 6 onwards, having to pay down the debt over that shorter period of time. So maybe now $900 per month increases to $1,750 per month, and that's obviously more expensive than just those P&I payments over 30 years at, say, $1,300 per month. So whilst interest only is very attractive in those early years from a cash flow perspective, it's going to hurt you, you're really going to feel the difference in the years after the interest only term expires. Now, in the past, it was very easy to roll this over. So 5 years interest only, you wanted to continue on that repayment option, just tick a box. Make a phone call and ask for that extension. That's getting a lot more difficult in this new lending environment as well. You may not be able to do it. So you might look to refinance at that time, and even that refinancing to interest only could be difficult. No banks are refinancing interest only above 80% at the moment. Certainly no major banks. So check your interest rate. If it's gone up, ask yourself, what are the benefits to you of having an interest only repayment option right now? And could you start saving a significant amount of money, 60, 70, 80, 90, 100 basis points, by potentially refinancing and switching to one of the cheap promotional P&I offers that are available now? And when you're doing that, look for who's offering these refinance rebates, who's going to put some more cash in your pocket to incentivize that change. And lastly, look at, do you have the income and the equity to potentially unlock or release some equity in this same process? Take some equity out of your loan and just put that into a 100% offset account, so you're not actually paying any interest on the additional borrowing until such time that you use those funds. But that additional cash out is going to set you up for the next steps on your property journey, being funding a deposit for a new house that you buy, making the next loan for that purchase a lot easier to obtain because you need less money, etc., etc. So obviously everyone's circumstances are different, but ask yourself those couple of key questions, and there could be some really good opportunities for you out there in the market right now to take advantage of this interest rate differential between interest only, much higher now, and P&I, a lot cheaper now. Thanks for your time. Good luck. Cheers.